Hi, my name is Anna Hess, your Patton University course instructor. This is Unit 3, Money Market Institutions. Here's the introduction. When you need cash, it seems pretty simple to take it out of your banking account. Just find the nearest ATM, enter your debit card and PIN number, and take out what you need. But did you ever stop and think about how the money got there? Believe it or not, when you put your money in a bank, it's not just sitting there waiting for you. The bank is engaged in a series of deals, lending and borrowing money, that allow it to operate and shoot out some cash when you need it. All this is possible in part due to a series of markets called money markets. Money markets are defined as the collection of institutions and trading relationships that move short-term funds from lenders to borrowers and back again. All money market loans have an original maturity of 1 year or less. Thus, money market transactions typically consist of credit flows from lenders and borrowers that last for only hours, days, weeks, or months, unlike the capital markets, where credit transactions may cover many years. Banks are among the most important financial institutions in the money market, providing credit to security dealers, industry firms, and other money market participants. Banks are also the principal channel for making payments in the money market, acting as guarantors of payment and as custodians for the safekeeping of financial instruments. Finally, banks serve as a key channel for government economic policy, particularly in regulating the supply and cost of money and credit. Okay, this is Objective 1. Starting on page 64, let's read. Financial institutions. Financial institutions are the firms that provide access to the financial markets, both to savers who wish to purchase financial instruments directly and to borrowers who want to issue them. Because financial institutions sit between savers and borrowers, they are also known as financial intermediaries, and what they do is known as intermediation. Banks, insurance companies, security firms, and pension funds are all financial intermediaries. These institutions are essential. Any disturbance to the service they provide will have severe adverse effects on the economy. To understand the importance of financial institutions, think what the world would be like if they didn't exist. Without an intermediary, individuals and households wishing to save would either have to hold their wealth in cash or figure out some way to funnel it directly to companies or households that could put it to use. The assets of these household savers would be some combination of government liabilities and the equity and debt issued by corporations and other households. All finance would be direct, with borrowers obtaining funds straight from the lenders. Such a system would be unlikely to work very well for a number of reasons. First, individual transactions between safe lenders and spender borrowers would likely be extremely expensive. Not only would the two sides have difficulty finding each other, but even if they did, writing the contract to effect the transaction would be very costly. Second, lenders need to evaluate the creditworthiness of borrowers and then monitor them to ensure that they don't abscond with their funds. Individuals are not specialists in monitoring. Third, most borrowers want to borrow for the long term, while lenders favor more liquid short-term loans. Lenders would surely require compensation for the illiquidity of a long-term loan, driving the price of borrowing up. A financial market could be created in which the loans and other securities could be resold, but that would create the risk of price fluctuations. All these problems would restrict the flow of resources through the economy. Healthy financial institutions open up the flow, directing it to the most productive investments and increasing the system's efficiency. The role of financial institutions. Financial institutions reduce transaction costs by specializing in the issuance of standardized securities. They reduce the information costs of screening and monitoring borrowers to make sure that they are creditworthy, and they use the proceeds of a loan or security issue properly. In other words, financial institutions curb information asymmetries and the problems that go along with them, helping resource flow to their most productive uses. At the same time that they make long-term loans, financial institutions also give savers ready access to their funds. That is, they issue short-term liabilities to lenders while making long-term loans to borrowers. By making loans to many different borrowers at once, financial institutions can provide savers with financial instruments that are both more liquid and less risky than the individual stocks and bonds that they would purchase directly in financial markets. Figure 3.2 is a schematic overview of the financial system. It shows that there are two types of financial institutions, those that provide brokerage services, top, and those that transform assets, bottom. Broker institutions give households and corporations access to financial markets and direct finance. Institutions that transform assets take deposits or investments or issue insurance contracts to the households. They use the proceeds to make loans and purchase stock, bonds, and real estate. That is their transformation function. The figure 3.3 shows what the balance sheet for such an institution would include. Financial institutions perform both brokerage and asset transformation services. As brokers, they provide access to financial markets, allowing households and firms to buy and sell direct claims on other firms and other governments. Institutions transform assets by taking deposits or investments or issuing insurance contracts to households at the same time that they make loans and purchase stock, bonds, and real estate. The structure of the financial industry. In analyzing the structure of the financial industry, we can start by dividing intermediaries into two broad categories, called depository and non-depository institutions. Depository institutions take deposits and make loans. They are what most people think of as banks, whether they are commercial banks, saving banks, or credit unions. Non-depository institutions include insurance companies, security firms, asset management, firms that operate mutual funds and exchange-traded funds, hedge funds, private equity or venture capital firms, finance companies, and pension funds. Each of these serves a very different function from a bank. Some screen and monitor borrowers, others transfer and reduce risk. Still others are primarily brokers. Here's a list of the major groups of financial institutions, together with a brief description of what they do. In the blog, Banking the Masses. The World Bank estimates that in 2014, about 2 billion adults aged 15 years and older had no access to modern finance. No bank deposit, no formal credit, and no means of payment other than cash or barter. Yet that huge figure was down sharply from 2011 estimate of more than 2.5 billion unbanked. In just 3 years, and despite a rising population, a net of 700 million adults gained access to at least basic financial services. This spectacular progress is very welcome. The rise of financial inclusion access by lower-income households to banks and the payment system is near the top of the list of social advantages that governments are encouraging. Few consumer products have ever diffused as rapidly as banking access has in recent years, especially among the world's poor. Still, we have a very long way to go. Of the roughly 62% of adults with some financial access, we have only a tenuous link. Broadening and deepening financial inclusion will remain a challenge for a generation. Why should we care? The answer is that financial access promotes both economic equality and economic growth. Think about the things that banks do for us: provide low-cost access to sophisticated payment system, safeguard funds and provide convenient accounting, reward savers with interest, and help diversify risk. When the system functions well, banks also allocate savings to the most efficient uses, screening and monitoring investment projects to select those with the highest return to both individual investors and society as a whole. You'll want to finish this reading on your own. After finishing the reading, there's a video called Money Market Funds that you should watch, an external page called Money Markets Defined, a video called How the Money Market Works, and then there's an activity of flashcards to review. This concludes Objective 1. On to Objective 2. This is called The Economics of Financial Intermediation. The financial crisis of 2007 to 2009 alerted everyone that general economic well-being is closely tied to the health of the financial institutions that make up the financial system. The financial system is a lot like plumbing. When it's working well, we pay little attention, but its failure almost inevitably leads to a costly economic mess. The breadth, depth, and persistence of financial disruptions in the crisis brought us closer to the Second Great Depression than at any time since the first one in the 1930s. As described in Chapter 1, our financial system is made up of 6 components: money, financial instruments, financial markets, financial institutions, government regulatory agencies, and the central bank. In parts 1 and 2, we covered the first 3 of these components. Part 3 will focus on the fourth, financial purpose, which is known as financial intermediation. As we learned in Chapter 3, financial institutions intermediate between savers and borrowers, and so their assets and liabilities are primarily financial instruments. Various sorts of banks, brokerage firms, investment companies, insurance companies, and pension funds all fall into this category. These are the institutions that pool funds from people and firms who save and lend them to people and firms who need to borrow, transforming assets and providing access to financial markets. They funnel savers' surplus resources into home mortgages, business loans, and investments. As we discussed briefly at the end of Chapter 3, financial intermediaries are involved in both direct finance, in which borrowers sell securities directly to lenders in the financial markets, and indirect finance, in which a third party issues claims to those who provide funds and acquire claims to those who use them. Intermediaries investigate the financial condition of the individuals and firms who want financing to figure out which have the best investment opportunities. As providers of indirect finance, banks may want to make loans to the highest quality borrowers. When they do their job correctly, financial intermediaries increase investment and economic growth at the same time that they reduce investment risk and economic volatility. Ensuring that the best investment opportunities and highest quality borrowers are funded is extremely important. Any country that wants to grow must ensure that its financial system works. When a country's financial system crumbles, its economy fails with it. That is what happened in the United States in the Great Depression of 1930s, when a series of bank closings was followed by an increase in the unemployment rate to more than 25% and a fall of nearly 1/3 in the level of economic activity measured by GDP. The Asian crisis of 1997, in which banking systems of Thailand and Indonesia collapsed, is a more recent example. The deep, prolonged economic plunge of 2008 and 2009 highlights how a financial crisis, once started, can spread devastation across the global economy, triggering a spiral of economic and financial decline that is difficult to halt. And the subsequent turmoil in the euro area depressed some economies in the region enough to rival the traumatic 1930s experience. Without a stable, smoothly functioning financial system, no country can prosper. The strong relationship between financial development and economic development is clearly apparent from the data. Figure 11.1 plots a commonly used measure of financial activity, the ratio of credit extended to the private sector, both through financial intermediaries and market, to gross domestic product, GDP, against real GDP per capita. The resulting positive correlation, roughly 0.6, is no surprise. With few exceptions, rich countries display advanced levels of financial development. In theory, the market system may seem neat and simple, but the reality is that economic growth is a messy, chaotic thing. The flow of information among parties in a market system is particularly rife with problems that can derail real growthiness. They are addressed properly. In this chapter, we will discuss some of these information problems, including several that contribute to the financial crisis of 2007 to 2009, and learn how financial intermediaries attempt to solve them. The role of financial intermediaries. Markets are remarkably effective at coordinating the behavior of millions of firms and households in an economy. And financial markets are among the most important markets of all. They price economic resources and allocate them to their most productive uses. In many countries over the past 25 years, the value of stock and bond markets has come to rival or even surpass the value of outstanding loans through financial intermediaries. But as we will see, intermediaries, including banks and security firms, continue to play a key role in both of these types of finance. Table 11.1 illustrates the importance of different channels of finance. As you look at the table, note two things. First, to make comparisons across countries of vastly different size, we measure everything relative to GDP. Second, there is no reason that the value of a country's stock market, bonds outstanding, or bank loans cannot be bigger than its GDP. In fact, We would expect it to be much larger because the value of a company to its owners is often several times the level of 1 year's sale. This means that when you add up all types of financing, direct and indirect, as a percentage of GDP, the numbers will generally sum to more than 100 in an advanced economy. To see the lessons from the table, take the example of France in the first row. The value of the French stock market, the value of the shares of all the companies listed in the exchanges, is equivalent to 60.7% of that country's GDP, column A. The value of French debt securities is 45.2% of GDP, column B. Adding column A's and B tells us that in France, securities finance equals 105.9% of GDP. That exceeds the amount of credit extended by French banks and other intermediaries. 95% of GDP, column C. The final column, D, reports the ratio of loans to securities. For France, the result is 0.9, which means that financing via security markets was somewhat larger than loans. For the advanced economies in the table, the range of that ratio is between 0.79 and 1.35, so the French case is not unusual. In many emerging markets, the ratio is somewhat lower because in recent decades, their stock markets have expanded notably. However, domestic private debt securities play only a small role in most emerging market economies, which underscores the cost and challenges of developing this alternative to loan and stock finance. The biggest difference among the emerging economies is in the sale of loans, which range from less than 17% of GDP in Argentina to more than 100% in China. These data highlight the importance of intermediaries. Banks are still critical providers of financing around the world, although bank lending may not be the dominant source of financing that it once was. And intermediation is not limited to bank lending. Intermediaries determine which firms can access the stock and bond markets, just as banks decide the size of a loan and the interest rate to be charged. Securities firms set the volume and price of new stock and bond issues when they purchase them for sale to investors. And other intermediaries, like mutual funds, help individual investors sort among the thousands of stock and bonds that are issued to develop a diversified portfolio with the desired risky characteristics. Why are financial intermediaries so important? The answer has to do with information. To understand the importance of information and the role financial intermediaries play in the economy, consider the online company eBay. This virtual auction house may seem like an unlikely place to start, but while eBay deals primarily with physical objects, it faces some of the same information problems as financial firms. And as an online intermediary, eBay provides a mechanism through which almost anyone can auction off almost anything. As of early 2016, upwards of 800 million items were listed for sale at www.ebay.com. Everything from $5 dinner plates to a $21 million incense burner from China's Northern Song Dynasty, 1960 to 1127 AD. And people buy them. For just the single year 2015, eBay reported total transactions valued at more than $80 billion, entered in by more than 160 million active users. While millions of items are on sale on eBay, if you look carefully, you'll notice an absence of financial products. You can purchase collectible coins and paper currency on eBay, but you can't borrow. There are no listings for Samantha's student loan, Chad's car loan, Chloe's credit card balance, or Mort's mortgage. At least not yet. And though you can buy defaulted bond certificates like the Reading Railroad bond shown in Chapter 4, which was purchased on eBay, you can't buy or sell bonds on which the issuer is still making payments. People are selling cars and even real estate on eBay, but no one is auctioning off checking account services. Think for a moment about why eBay doesn't auction off mortgages. First, Mort might need a $100,000 mortgage, and not many people can finance a mortgage of that size. The people who run eBay could try to establish a system in which 100 people sign up to lend Mort $1,000, but it would be extremely complex and cumbersome. Imagine collecting the payments, figuring out how to repay the lenders, writing out all the legal contracts that go with the transaction. Just as important, before offering to finance Mort's mortgage, lenders would want to know something about Mort and the house he's proposing to buy. Is Mort accurately representing his ability to repay the loan? Does he really intend to buy a house with the loan? The questions are nearly endless. See Chapter 12 in the blog, The Cloudy Future of Peer-to-Peer Lending. Financial intermediaries exist so that individual lenders don't have to worry about getting answers to all of these questions. Most people take for granted the ability of the financial system to shift resources from savers to investors. But when you look closely at the details, you're struck by how complicated the task is. It's amazing the enterprise workers at all. Lending and borrowing involves both transaction costs, like the cost of writing a loan contract, and information costs, like the cost of figuring out whether a borrower is trustworthy. Financial institutions exist to reduce these costs. In their role as financial intermediary, financial institutions perform 5 functions. See Table 11.2. 1. Pooling the resources of small savers. 2. Providing safekeeping and accounting services, as well as access to the payment system. 3. Supplying liquidity by converting savers' balances directly into means of payment whenever needed. 4. Providing ways to diversify risk. And 5. Collecting and processing information in ways that reduce information costs. As we go through these, you'll see that the first 4 have to do with lowering transaction costs. That is, by specializing and providing these services to large numbers of customers, a financial firm can reduce the cost of providing them to individual customers. As in other fields, experts can do a better job than others, and more cheaply than that. The 5th function on the list, collecting and processing information, is a category all by itself, so we'll consider it in more detail. While we will not discuss international banks in any depth, it is worth mentioning that we will provide an additional set of services that complements those offered by your neighborhood bank. International banks handle transactions that cross national borders. That may mean taking deposits from savers in one country and providing them to investors in another country. It may also mean converting currencies in order to facilitate transactions for customers who do business or travel abroad. You'll want to finish this reading on your own. When you're done with this reading, you'll see there's an external page called Functions and Examples of Financial Intermediaries that you'll want to read. Then there's another external page called What Do Financial Intermediaries Do? Then there's a reading called Discussion, Asymmetric Information, and lastly there's some flashcards to review. This concludes Objective 2. Okay, this is Objective 3. Let's read together. Future value, present value, and interest rates. Lenders have been despised for most of history. The borrowers must pay for their loans, while the lenders just sit around doing nothing. No wonder people have been vilified for charging interest. No matter that, for centuries, clearest pointed to biblical passages damning interest. Even philosophers weighed in against the practice, including Aristotle, who called the breeding of money for money unnatural. After scorning lenders for millennia, we now recognize their service as a fundamental building block of civilization. Credit is one of the critical mechanisms we have for allocating resources. Without it, our market-based economy would grind to a halt. Even the simplest financial transactions, like saving some of your paycheck each month to buy a car, would be difficult, if not impossible. And corporations, most of which survive from day to day by borrowing to finance their activities, would not be able to function. Credit is so basic that we can find records of people lending grain and metal from 5,000 years ago. Credit probably existed before common measures of value, and it predates coinage by 2,000 years. Despite its earlier existence and its central role in economic transactions, credit was hard to come by until the Protestant Reformation. By the 16th century, views had changed and interest payments were tolerated, if not encouraged, so long as the rate charged was thought to be reasonable. Some historians even point to this shift as a key to the development of capitalism and its institutions. Protestant European countries did develop faster than Catholic ones, at least at first. Since then, credit has exploded, facilitating extraordinary increases in general economic well-being. Yet, even so, most people still take a dim view of the fact that lenders charge interest. Why? The main reason for the enduring unpopularity of interest comes from the failure to appreciate the fact that lending has an opportunity cost. Think of it from the point of view of the lender. People who offer credit don't need to make loans. They have alternatives, and extending a loan means giving them up. While lenders can eventually recoup the sum they lend, neither the time that the loan was outstanding nor the opportunities missed during that time can be gotten back. So interest isn't really the breeding of money for money, as Aristotle put it. It's more like a rental fee that borrowers must pay lenders to compensate them for lost opportunities. It's no surprise that in today's world, interest rates are of enormous importance to virtually everyone. Individuals, businesses, and governments, quoted as a percentage of the amount borrowed, interest rates link the present to the future, allowing us to compare payments made on different dates. Interest rates also tell us the future reward for lending today, as well as the cost of borrowing now and repaying later. To make sound financial decisions, we must learn how to calculate and compare different rates on various financial instruments. In this chapter, we'll explore interest rates using the concepts of future value and present value, and then apply these concepts to the valuation of bonds. Finally, we'll look at the relationship between interest rates and inflation. Valuing monetary payments now and in the future. To compare the value of payments made on different dates, we need a set of tools called future value and present value. We'll use them to see how and why the promise to make a payment on one date is more or less valuable than the promise to make a payment on a different date. For example, if we already know that you want to borrow $100 today, but your repayment needs to be bigger if you promise to make that in a year than if you promise to make that in a month. But how much more will you have to pay? The answer depends on both the date of payment and the interest rate. For the time being, we're going to assume that we know for sure that you will repay the loan. We'll get to the possibility of default when we study risk in the next chapter. Future value and compound interest. What is the future value of $1 deposited in an interest-bearing account today? To answer this question, let's start with the definition. Future value is the value on some future date of an investment made today. Say that today you invest $100 in a savings account that guarantees 5% interest per year. After 1 year, you'll have $105. The investment adds present value of $100 plus $5 in interest. So the future value of $100 1 year from now at an interest rate of 5% is $105. We could also say that the $100 investment yields $5, which explains why an interest rate is sometimes called a yield. Notice that the same calculation works for a simple loan in which you borrow $100 for 1 year at 5% interest. The amount you will need to repay is $105. Remember, core principle 1, time has value. To generalize this concept so that we can handle different interest rates in initial investments of any size, we can express it mathematically. First, we need to convert the percentage interest rate into a decimal so that 5% becomes 0.05. Note that in this expression, as in all mathematical manipulations in this chapter, the interest rate is expressed in decimal terms. Now we can express future value as an equation. If the present value of your initial investment is $100 and the interest rate is 5%, then the future value 1 year from now is present value of the investment plus interest equals future value in 1 year. It is essential to convert all interest rates to decimals before doing any computation. This is consistent with the fact that we quote interest rates as parts per 100. So 5% means 5 parts per 100, or 0.05. This expression shows us immediately that the higher the interest rate, the higher the future value. If the interest rate were to rise to 6%, then the future value of 100 would be, in general, the future value, FV, of an investment with a present value, PV, invested at an interest rate, I, is future value in 1 year is present value of the investment today times 1 plus the interest rate. We can see right away that the higher the interest rate or the amount invested, the higher the future value. But this example is too simple. Most financial instruments don't make single payments in exactly 1 year. So we need to figure out what happens when the time to repayment varies. Computing the future value of an investment to be repaid 2 years from now is straightforward. So let's do that first. But because we quote interest rates on a yearly basis, we need to be careful. Using 1 year interest rates to compute the value of an investment that would be repaid more than 1 year from now requires applying the concept of compound interest, which is interest on the interest. If you leave an investment in an interest-bearing account for 2 years, during the second year you will receive interest not only on your initial investment, but also on the interest you earn for the first year, because they both have opportunity costs. You're going to want to finish this reading on your own. After finishing the reading, you'll watch a video called Present Value, then you should read an external page called Future Value, and then there's an activity of flashcards to review. This concludes Objective 3. Okay, for Objective 4, we're going to start reading on page 223. Options. Everyone likes to have options. Having the option to go on vacation or buy a new nice car is nice. The alternative to having options, having our decisions made for us, is surely worse. Because options are valuable, people are willing to pay for them when they can. Financial options are no different. Because they are worth having, we can put a price on them. Calculating the price of an option is incredibly complicated. In fact, no one knew how before Fisher Black and Myron Scholes figured it out in 1973. Traders immediately programmed their famous Black-Scholes formula into the computers available at the time, and the options market took off. By June 2000, the market value of outstanding options was in the neighborhood of $500 billion. Today, hundreds of millions of options contracts were outstanding, and millions of them changed hands every day. Before we learn how to price options, we'll need to master the vocabulary used to describe them. Once we have the language, the next step is to move on to how to use options and how to value them. Calls, puts, and all that definitions. Like futures, options are agreements between two parties. There is a seller, called an option writer, and a buyer, called an option holder. As we will see, option writers incur obligations while option holders obtain rights. There are two basic options, puts and calls. A call option is the right to buy, call away a given quantity of an underlying asset at a predetermined price, called the strike price or exercise price, on or before a specific date. For example, a July 2016 call option on 100 shares of Apple stock at a price of $100 gives the option holder the right to buy 100 shares of Apple for $100 apiece prior to the third Friday of July 2016. The writer of the call option must sell the shares if and when the holder chooses to use the call option. If the holder of the call is not required to buy the shares, rather the holder has the option to buy and will do so if buying is beneficial. When the price of Apple stock exceeds the option price of 100, the option holder can either call away the 100 shares from the option writer by exercising the option or sell the option to someone else at a profit. If the market price rose to $105, for example, then exercising the call would allow the holder to buy the stock from the option writer for $100 and reap a $5 per share profit. Whenever the price of the stock is above the strike price of the call option, exercising the option is profitable for the holder, and the option is said to be in the money, as in, I'm in the money. If the price of the stock exactly equals the strike price, the option is said to be at the money. If the strike price exceeds the market price of the underlying asset, it is termed out of the money. A put option gives the holder the right, but not the obligation, to sell the underlying asset at a predetermined price on or before a fixed date. The holder can put the asset in the hands of the option writer. Again, the writer of the option is obliged to buy the shares that the holder chose to exercise the option. Returning to the example of Apple's stock, consider a put option with a strike price of 100. This is the right to sell 100 shares at $100 per share, which is valuable when the market price of Apple stock falls below $100. If the price of a share of Apple stock were $90, then exercising the put option would yield a profit of $10 per share. The same terminology that is used to describe calls in the money, at the money, and out of the money applies to puts as well, but the circumstances in which it is used are reversed. Because the buyer of a put obtains the right to sell a stock, the put is in the money when the option strike is above the market price of the stock. It is out of the money when the price stock is below the market price. While it is possible to customize options in the same way as forward contracts, many are standardized and traded on exchanges. Just like futures contracts, the mechanics of trading are the same. A clearing corporation guarantees the obligations embodied in the option, those of the option writer, and the option writer is required to post margin. Because option holders incur no obligation, they are not required to post margin. There are two types of calls and puts, American and European. American options can be exercised on any date the time they are written until the day they expire. As a result, prior to the expiration date, the holder of an American option has three choices. 1. Continue to hold the option. 2. Sell the option to someone else, or 3. Exercise the option immediately. European options can be exercised only on the day that they expire. Thus, the holder of the European option has 2 choices on a date prior to expiration: hold or sell. The vast majority of options traded in the United States are American. Using options. Who buys and sells options and why? To answer this question, we need to understand how options are used. Options transfer risk from the buyer to the seller, so they can be used for both hedging and speculation. Let's take hedging first. Remember that a hedger is buying insurance. For someone who wants to purchase an asset such as a bond or a stock in the future, a call option ensures that the cost of buying the asset will not rise. For someone who plans to sell the asset in the future, a put option ensures that the price at which the asset will be sold will not go down. To understand the close correspondence between options and insurance, think of the arrangement that the automobile owners have with their insurance company. The owner pays an insurance premium and obtains the right to file a claim in the event of an accident. If the term of the policies are met, the insurance company is obliged to pay the claim. If no incident occurs, there is no claim and the insurance company makes no payment. The insurance payment is lost. In effect, the insurance company has sold an American call option to the car owners, where the underlying asset is a working car and the strike price is 0. This call option can be exercised if and only if the car is damaged in an accident on any day before the policy expires. Options can be used for speculation as well. Say that you believe that the interest rates are going to fall over the next few months. There are 3 ways to bet on this possibility. The first is to purchase bond outright, hoping that the price will rise as interest rates fall. This is expensive because you will need to come up with these resources to buy the bond. A second strategy is to buy a futures contract, taking the long position. If the market price of the bond rises, you will make a profit. As we saw in the last section, this is an attractive approach because it requires only a small investment, but it's also very risky because the investment is highly leveraged. Both the bond purchase and the futures contract carry the risk that you will take a loss, and if interest rates rise substantially, your loss will be large. The third strategy for betting that interest rates will fall is to buy a call option on the U.S. Treasury bond. If you were right and interest rates fall, the value of the call option will rise. But if you are wrong and interest rates rise, the call will expire, worthless, and your losses will be limited to the price you paid for. This bet is both highly leveraged and limited in its potential losses. You'll want to finish this reading on your own. After finishing the reading, you'll want to watch a video called How the Stock Exchange Works. Then read something called Southwest Airline Flies $14 Unless Hedging Losses Eat Profits. Then there's an activity of flashcards to review. This concludes Objective 4.